Hey, everybody, this is kind of a bonus episode, but even though it's a weekly episode, it's a little longer than usual because it's actually the live replay of the webinar that Paul and I hosted in February, the Wealth Warehouse webinar that we're starting every month now. So the next one is in March. So check the registration link in the show notes here for March 13th. But Paul, we covered quite a bit and had a lot of good Q&A in this one.
Yeah, we did, and I think it's going to be valuable for people to watch because you get to see real people who are not clients asking questions and getting to see hear us answer them, and I think it's good, and I think most people found it productive, and we've got meetings with several of them in the upcoming weeks. So stay tuned.
Yeah, yeah. So again, check the show notes for the next one. We'll see you there. Hey, I'm Dave.
And I'm Paul.
And this is the Wealth Warehouse Podcast. Good to see a lot of familiar faces. Yeah, we'll go ahead and get started. Paul, do you got any ground rules you want to lay out?
No, I don't. I don't anticipate if we're going to have any detractors. Several years ago, Dave and I, in our infancy in this business, it was actually somebody that I knew who ended up being a complete jerk that we invited to a webinar that we had back in 2020, I think. And, big Dave Ramsey guy and just whatever. So if you're one of those, that's fine. You're welcome to be here. Please ask questions. I guarantee you're going to learn something. As Nelson Nash used to say, Dave, most people's understanding of dividend paying whole life insurance is based on somebody else's misunderstanding. So it's one of those, you don't know what you don't know, but we do know, and there's a bunch of our clients on here as well. So just be polite and just keep an open mind.
Yeah, and we'd love for maybe any clients to answer some of the questions that come up as well. We don't need to be the only ones talking here. So if anybody's got some input or wants to take a hack at answering a question, please do. So, well, I guess for the sake of those who maybe are meeting us for the first time, as way of introductions, I'm David Beffert, and that's Paul Fougere, and we host the Wealth Warehouse Podcast, who I assume most of you have listened to. And we've been doing infinite banking. I've been practicing since 2010 and been doing this as a business for, I think, going on my year 7. And Paul's right behind me. Paul was my first client ever, the most ideal client in the world. I sent him a book and he said, let's do it. I don't have to say anything else. So I need more people like that. No, I'm kidding. I like answering questions and talking to everybody about it. But yeah, I've been doing this full time for several years, and that's what I do all week. Love it. Paul, what do you got?
Yeah, well, you heard it. I was Dave's first client. So I started off, I've owned whole life insurance for, since 2003. I just didn't own exactly the right kind that we use for the infinite banking concept. But, Dave sent me the book. He sent me the case for IBC, which is right there on the shelf. And then I read this book right after and knew that this was kind of what was missing from my overall portfolio. I was a real estate investor. I was a private money lender. I had done all those things prior to practicing the infinite banking concept. But yeah, I love it. And retiring from the Army this month. You are now seeing me in retirement mode. I'm on terminal leave right now after almost 23 years of active duty in the United States Army, and which is so great. Anyone who's retired, I know my buddy John is in the room, and Matt, and maybe a few others. It's a great feeling. Anyway, so this is all I do now is take meetings with people that want to practice the infinite banking concept, and I think it's what Dave and I were meant to do because we love doing it. So glad to be here.
Yeah. Well, cool. So we didn't have any, not a specific topic planned for today. We're just kind of rebooting the webinars that I think we'll try to do this once a month and maybe have set topics or client case studies as we go forward. So if any of you guys who are clients have anything you'd like to share with the community in a future webinar, just let us know. And we can share your case study, some way that you've utilized this concept in your life to improve your situation, or to take advantage of an opportunity that maybe you wouldn't have had you not implemented this concept. But I guess just to get started, maybe Paul and I will go back and forth a little bit to get the wheels spinning on some questions for that you all can come to the table with, and then we'll take these questions here in the chat and then open it up, Q&A. We'll do this. I like to keep things right at about an hour. I'm very militant about timing, so we'll cut this off at the hour point, and if we got more questions, we'll get those answered maybe on the next podcast episode, to make sure you guys all get every question answered that you need. But hey, Paul, just starting with you, why did you get involved in IBC, in the infinite banking concept? Like what attracted you to it?
Well, I think I have a certain view of the world, and independent, and I was thinking about what to say. I was frustrated at the time. I remember being very frustrated with my financial not my advisor, but the advisory process that I had been experiencing for my entire Army career. I remember going to my weekly or my annual checkups, and it was never. I always thought that the rates of return I was getting were crappy, and they were, and the fee structures were stacked against me, which they were. But I never really dedicated any brain power to being like, all right, what else can or should I be doing to better my position? So, fast forward to 2013, 2014, Dave and I are in Afghanistan together, chit-chatting, and then fast forward several years after that, and he sends me the book, and he says, hey, read this book. Prior to that, I had gotten some real estate education, gotten into private money lending, buying some real estate, some investing in fix and flips, and doing some buy and hold and stuff like that. And then, everything in the book just resonated with me, like it made complete sense. And I was like, wow, so you're telling me I can have whole life insurance, which I thought of as a burden at the time. I had regular vanilla non-dividend paying whole life. I paid about $1,000 a month of premium across we had 10 policies, even back then. It's ironic because I have 10 now, which is kind of funny. But I always, every time we went to buy more, I was like, I just don't want to buy more. I've got $800,000 of death benefit. Isn't that enough? And my advisor, to her credit, was like, no, it's not enough. and she was right. So I just, it's a complete mindset switch, I guess, Dave, for me. And you sent me that book at exactly the right time. It was the right moment for me to catch it. I understood everything about it. And I didn't go into, like you said, big details, like show me the numbers. What's the internal rate of return? I didn't ask any of those questions, or at least I don't remember asking them. I just remember big picture. I was like, this is what's been missing from my financial portfolio, in my life. This is how I want to run my family business, right? So yeah, that's just, I'm a pretty simple guy. Like, this is it.
Yeah. Cool. And is this the only thing you do with your money? Throw it in whole life insurance?
No, like, if you guys have been listening to the podcast for a while, this is just like the first place we put our money. And I was telling somebody this last night. I still invest. I'm not a big stock market guy. Some people are. Some people crush it. That's great. It's just not my cup of tea. I'm more of a cash flow investor. That's something I discovered back in the mid 2015, 2016, was investing for cash flow. So no, certainly it's just my money. It goes to my policies first, and then it goes and does other things, and then the returns that I get go back to my policies. So I just use it as like a revolving door of money, and it's an increasing line of credit. It goes up every year, right? I'm paying my premiums. The cash value that I have available to myself grows uninterrupted, even while I'm leveraging it. So it's just a great place to keep money. And that's very, don't overcomplicate this, folks. Like, this is quite simple. This is just a different place to put money. It has to be somewhere, right? It has to reside somewhere. And I think we know this is the best place for it.
Yeah. As an initial stop. or as the first place I want to sequence it.
Yeah, I think yesterday I was talking to somebody and I was like, pretend you have a horse and someone and you're riding the horse. Eventually the rider is going to get off and he's going to go do something else. He has to go to the general store, pick up some firearms and some ammo and some food and provisions, but he's going to go do other things. Well, that's the cash value of your whole life policy. It's there when you need it. It's going to get off the horse, going to go do something. It's going to come back. It's going to get back on. It's going to go do something else. And our money does that. It does many different things all at the same time.
Yeah. Almost as if the need for financing is a pretty important part of your life.
Yeah, absolutely.
So, I mean, there's the financing, then there's the investing. They're two different things, the way I see it. So a lot of people have 401ks, great. You get a match, or maybe you're fortunate to like many of the pilots here in this on this webinar who get a company that funds a 401k for them. That's great. But you can't use that money to finance anything. You can't use it for opportunities that come along. So how have your opportunities, Paul, changed since you started doing this and had access to, because before this you were putting a lot of money in TSP,
yeah,
the
for
military
sure.
retirement and locking it up in different places, right, for the future. But how has this changed the opportunities that you've been able to take part in?
Well, I think your aperture for stuff really opens up once you, and again, you listen to the podcast, we say this all the time, but you start to look at the landscape completely differently. I used to think that I was on the path to prosperity because I was maxing my 401k contributions in the military. I was, at the time when I could contribute to a Roth IRA, I was maxing that, and but I wasn't looking to do anything else. That was just it. And then I was going to retire and have a pension, right? And hopefully have enough in those other accounts to fund my passive income years, my retirement years. And now, once I kind of flipped that switch and I started putting capital where I could get to it, and I understood how the whole system worked together, and I could leverage my capital, still have my capital growing all at the same time, all in a private environment. Gosh, we've done, I don't know how many private loans now, double digits for sure, probably approaching 20 different opportunities over the last 6 to 7 years. Some that are short term, some 6 months, some 90 days, some 3 years. I mean, all across the spectrum. So, and now I'm refusing opportunities because I was talking to your old business partner, Dave, the other day.
Yeah.
Just doing a little check-in with him, and said no thanks. I'm not interested in putting any more capital over there. And but the opportunities are endless. They just keep coming across your desk all the time. And the right network is important too. It's opened up my network of people. And there's people in this room that are doing private lending on their own. They're doing other things on their own. They're starting businesses. They're all kinds of stuff. So yeah, it really changes your financial landscape, I think, and how you see the world. And you realize, you're smart enough to, either create opportunities for yourself or invest in other people's opportunities that are safe and that you find profitable.
Yeah, I think you're right. I mean, as soon as I had capital, opportunities started coming my way, and I would get excited about a lot of them. But now it takes a whole lot to get me off the couch to even consider an opportunity. I just don't get excited about too many of them anymore unless I can more or less guarantee the return of my capital.
That's right.
And get some good cash flow in between.
Sure.
So yeah, it's definitely made me a much better investor and more patient investor.
Yeah, for sure. I think you start thinking like a banker, folks, and that's how you should think. The banks, when you get money from a bank, it's fully collateralized, right? They can take everything you own until they're whole, and they will, and they will.
They've got no souls.
No, they don't.
Yeah, but and then you mentioned your network. Like that's one of the greatest things that's happened to me over the last, especially like the last 7 or 8 years when I've really been diving deep into infinite banking, is how much my network has expanded in that time. and you meet one person that leads you to another. Like everybody on here who I recognize came from either directly from this business or from somebody else in this business connected me to. Like I see Dave Forbes down here. Like I met him through another guy who I met through infinite banking, and now we've gotten to know each other really well and gone hunting together and shared life together. It's been fun. And he's going to come pick me up in his Beechcraft here before too long and take me on a trip. Maybe pick me up on the way to South Dakota this fall, will you, Dave? So I don't have to drive.
You got it.
All right. So, all right. Well, we could go on and on, but we got some questions here. Let's start hitting those. So,
Yeah, we got a bunch.
Yeah, well, I'll just start at the top. Stephen asks, how is income verified? So really, it depends. Unless you're trying to get more than like $5 million in death benefit, it's really just whatever you put down on paper. Now, you got to be honest when you're filling out the application. Be truthful, but they don't verify it with tax returns unless you're going for more than like $5 million.
Yeah, yes, I would concur with that. Generally, if during the application process, you're going to list your income, your net worth, your assets, liabilities, and that's normally, there's usually follow-up questions to that, but generally that's enough. You don't have to provide returns unless, like you said, for if you're trying to go really, really big.
Yeah. Now, non-working spouse. So, yeah, if you're working, you're pulling in income, your death benefit, the max amount you can qualify for as death benefit is a factor of your age and how much money you make. So for someone like myself, say 45 years old, I can multiply my annual gross income by about 20. And that's how much death benefit I can have.
Right.
Now, for the non-working spouse, they can typically qualify for the same amount as the working spouse. So you're not really limited by the fact that you don't make any income, right? That wouldn't really be fair. But if if there is a breadwinner who brings in the majority and then another spouse who does work, let's say you have a pilot and you have a school teacher, their incomes are going to differ quite a bit. Well, the school teacher goes off the school teacher's income to determine their max insurability because they have a full-time job. So if you work full-time, it's going off your income. If you don't, you get to go off the breadwinner's income.
Yeah, and normally, we're getting to folks. I would say, our average clients are similar to us. Dave and I are 45 years old. I would say most of our clientele are in their 40s and 50s, or probably a majority. I would say, you're not going to, I don't think, run out of premium dollars necessarily. You're gonna pay as much premium as you can pay, and you'll still have death benefit space to expand in the future, if that makes sense, in case you have a windfall or something. Like, very few people have enough whole life premium that they can pay and still live and get to their max insurability. Does that make sense? So normally there's going to be some term component, so you can bridge that death benefit gap to get to your full human life value. So Dave and I are both, and several people in here, we're big proponents of owning convertible term insurance as well, which is fully underwritten. It can be converted to whole life. Rand, I'll get to your questions, not specifically on this thing, but I've got an email drafted up ready to send to you. But anyway, big proponent of convertible term.
Yep, to bridge that gap until you, can start funding premium for it, make it whole life. Yeah, that's my goal. Did you want to cover Rand's questions or go on to some others?
Who, Randa? Hers are very
Randa.
Hers are very specific to her.
Okay.
So let me just see if I can generalize it. So Rand, I'm going to share your. So Randa just opened up some convertible term, her and her husband, and her questions were basically like, what is it? The term conversion process is very simple. It's pieces of paper. Basically, we take your term life death benefit. We design a new whole life policy that's completely separate from that term policy, right? So you'll have a new whole life policy on the side, and we just convert a certain let's say she's got $1 million of death benefit and says, Paul, how much premium dollars would it take for me to convert $500,000 of that death benefit? And I just go in and reverse engineer a policy, a new whole life policy, and say it'll take, and I'm going to make up a number. It's going to take $25,000 a year of premium at your age. Okay, great. Let's do that. And then we just create the new whole life policy, fill out some paperwork, send it into the company, and they issue the new policy. The underwriting's already occurred with the term, right? So there's no additional underwriting. You could have cancer the next day or become type 1 diabetic, like we've had some clients that has happened to them, and it doesn't matter.
Yeah.
So that's how the term conversion process works. Very simple. And I just did it myself in January.
I just did it myself in January too.
Yeah, look at that.
Yep. New year, new policy. Oh, all right, cool. Stephen asks, I'd love to hear more about how youth whole life policies are structured. So Stephen's got a lot of good questions here.
Yeah.
So my assumption is, Stephen, you have not pulled the trigger on starting this concept yet. Am I assuming correctly? I'm going to go ahead and assume that.
Yes.
Cool.
He said yes.
Okay, great. I mean, we've got a lot of clients on here. We got a lot of people who practice infinite banking. We got people who are looking into it, exploring it, and just learning about it. So excellent. So for youth policies, they're different. The design is different because you can't have term insurance on a youth policy, a juvenile policy, so somebody under 18. So really, my preference, and I think Paul's the same way, we prefer juvenile policies to be heavier on the base so that over the course of that child's lifetime, they can pay more premium. Because that base, eventually the PUA is going to fall off and they're not going to be able to pay the max premium a lot earlier in life than say somebody getting a policy in their 40s. So to allow them to continue to pay more premium longer into life, because by that point, I mean, the older you are or the longer you've been doing this, the more efficient it gets, right? Every year, $1 a base premium is creating more and more cash value than the year before. So we don't want to cut the legs off of it. So we go heavier on the base, which just means the cash value accumulates slower, but over the course of a lifetime, you're going to get more out of it.
Yeah, I concur. I mean, my kids' policies are all base. There's no PUA whatsoever. I've kind of evolved on that over the years. That policy I just opened on myself is 70% base.
Yeah.
So you read different things, you listen to different things out there on the web, and people have their opinions, but later in the policy's life, your base premium is everything because the PUA rider is going to fall off. It's going to vanish, and then you're left with a base. So if your base is fat, good. If your base is too skinny, you're going to be wanting to pay more premium, and you can't. So think long range. Don't be afraid to capitalize. And dividend growth, little nugget of information. Dividends are driven off base premium.
Well, depending on the product, the policy. But yeah, the ones that we use. Because there's other whole life products that maybe the base is not participating.
Correct. But the ones we use, the base is, right.
Yeah, the base does the heavy lifting.
The ones Dave sold me first is not the case.
That's not true. They changed up the policies in 22.
They did.
So that was a good product before 2022.
It's doing great. Yeah. It's really good.
All right. So let's see. TC, and not a client of mine, Paul. Do you know TC?
I hope not. I don't recognize it.
Okay. Would like to know what is the proper way to do whole life insurance? That is a broad question. You want to come off mute and narrow that down?
Well, hey guys, David, I messaged you probably like a year now, more than a year now, on LinkedIn, but I don't think you respond to your LinkedIn messages.
That's probably true.
Yeah, I know I don't.
Yeah, no, I've been looking pretty much at getting a whole life insurance for me and my family for almost a year right now, and I work through a bunch of different people, and we get different information. My question is, what is the proper way to do it? Meaning that what is the proper way of doing it so that we can actually implement the infinite banking concept, right? Because there's whole life that have all these other aspects to it, and then you can get it from a lot of different companies. I mean, as far as the I forget what the terms are, right? Not the company you're getting, not the person you're getting it from, not the agent, but the company they're assigning the whole life insurance from,
Hmm.
and how they set it up with like how they're backing it up.
Don't touch my face.
Yeah. So that's a question that has an it depends answer. It's really all based on your personal situation. There's no one cookie cutter answer to that. I would say where you want to start though, and I think Paul and I just did an episode on this. The first place to start, besides getting educated, right? Reading Nelson's book, Becoming Your Own Banker. I highly recommend getting that, just reading it. Once you've done enough education, then it's really about finding the right person to work with. Somebody who's educated in infinite banking, ideally a practitioner that you could find on the NNI website. Because that person, like Paul and I, will have looked at many different companies and narrowed it down to the ones that we like the best, the ones that we think are the best for your particular situation. And then it's a matter of finding out what your cash flow situation is and what your goals are, and designing the policy appropriately to you, tailoring it to you. So there is no one proper way to do whole life insurance or to do the infinite banking concept. It's really individually tailored, but it's got to be, there are some things you have to do. It's got to be with a mutual life insurance company that's participating, meaning they pay dividends to policy owners. And ideally, you want to go through an IBC practitioner who knows exactly what they're doing, because there are some mistakes that could be made that could hurt you down the road if you don't go through the right person.
Yeah, spot on. I think also, and put it kind of broad, but following Nelson Nash's principles is important. You can Google, or I think ChatGPT knows what they are, for crying out loud. So you could just say, what are Nelson's 5 principles, and it'll tell you. But kind of following those in your journey is important, and referring back to his book often is good too, so you don't get amnesia. We've had clients like, why am I doing this again? Like, oh, come on.
Yeah. Oh, I just had one.
I had that book. I read that book, and it's got me. I think what you're saying is true. You need to find someone that you can work with that actually practices this, because I've talked to at least now 3 different people, and they have all told me very different ways to set it up, and said it'll work towards your what you're trying to do. And I told them I'm trying to do this, which is infinite banking concept, right? So. But they said, but they're all different, and it doesn't make any sense. There's got to be one particular way to do it that actually kind of fits, in the thing. So I think you're right. Just got to find somebody who understands the concept and works with it. Is where I'm at right now, I think.
All right. Well, perfect. Why don't you get on our calendar, me or Paul, and we can have a conversation more directed towards your situation and answer whatever other questions you got about your situation. You can throw whatever questions out here that you want to, but it sounds like you're ready to have a conversation with somebody.
Yeah, thank you.
Yeah.
How do you get on your calendar?
That's a great question. It's almost like we paid you to ask that question or something. Let me.
I'll put a link in the chat.
Rebecca,
Thank
can you
you,
put a link in
Rebecca.
the chat? Thank you. All right.
I'll take Zelle payment for the work, David.
What's that?
It's like you paid me. I'll take Zelle payment.
Yeah, right. I only deal in cash. Sorry.
Let's see.
So
Working
Steve's
our way
got more
down the
questions.
questions here. Yeah, you got a bunch.
Oh, I like
the
that
movie
one.
quotes. Yeah, you're welcome. Like,
Paul has more obscure movie quotes. He's really
Yeah.
big on those obscure. Do you have some kind of? Honestly, I don't think I've ever known somebody who's got the memory like Paul has. He can hear something one time and remember it forever.
so I have high cholesterol, and they say that people with high cholesterol not only live long, but they have like really high functioning brains.
Well, because your brain needs cholesterol. It's actually good for you.
I don't know. Yeah, see, Pete agrees with me.
Yeah.
No, I just have a good memory. My son's got it too. Just good at trivia and retaining worthless knowledge.
Yeah. Useless knowledge.
So this is good. So Steve, appreciate the questions. What percentage of annual income do you devote to whole life insurance premium, base, and PUA? Speaking generically, anytime an underwriter sees more than 15% of gross income on an application, so if you're making 100 grand and the premium is 20 or 25, they're going to ask about it. You know, if the premium is 15,000 total, illustrated premium between base and PUA, I don't really care what the breakdown is, but 15,000 total premium, they're okay with that. But anything above that, generally, the guidelines are they're gonna start asking, hey, we noticed that this is 25% of their total income. You know, how do they plan to fund this long term? Because it's important, right? Life insurance companies don't start making money on these policies for 13 years on average. Right, so you think they're greedy, Dave Ramsey thinks they're greedy or whatever. They don't make, and then the total life internal rate of return for the company on a policy is about 7%. So it's not awesome, right? It's a long term, long duration. They don't care about the next quarter. They're cared about the next quarter of a century, right? So anyway, 15% is safe. Personally, I'd have to go do some math to see what the heck I'm paying now, but I pay as much as I can.
Yeah, I think I recently looked at what I was doing, and it's just over 20%.
Yeah, I'd say it's about close to where I am, about 20%.
Yeah, I mean, and there's cases you can do based on your income. You could do up to 30% of your income.
Sure.
That's tough for most people to do right off the bat. That's usually something you kind of grow into.
Sure.
But I've had clients who've done that.
And then, kind of over time, right, your non-guaranteed but pretty reliable dividends that your policies receive become quite substantial, right? They become larger than the premium, in fact. Generally the policies that we design, the base premium can be paid by the dividend in year 12. Sometimes year 10. Generally in that area. So if your base premium is $10,000, that means your dividend in year 12 is around $10,000. So the dividends are a return of excess premium, which go back into your policy and buy more insurance, increase your cash value, of course. So you can look at that as kind of premium dollars as well, in a sense, but it doesn't count against you.
Yeah, and to, I guess, make it more your follow-up question there, kind of high income versus low income earners. I don't know if I really classify anybody as high versus low. It's really because Nelson says pay high premium relative to your income.
Right.
I mean, I had a client, one of my early clients, she made $30,000 a year and she paid $5,000 a year in premium, which is high relative to her income.
Sure.
But I'd say if you make over 150 a year, then you can put in closer to 30%. That's in general. Every company has little different underwriting criteria, but in general, if you make over 150, you can qualify for up to 30%. If you make less than that, then you're somewhere around 15 to 20%.
Yeah, and that kind of goes into Steven's next question, folks, if you're following along here. So that would be total premium paid, Steven, right? So if your income is 100 across 4 policies, let's say, for that family of 4, 15 to 20,000 a premium is probably what you're looking at in total. Because again, the concern is, we often say we're not trying to make people premium poor. That's not the point of this. We're going to start where you're at. And that's the best way to practice IBC. Your premium is going to be different than mine. Mine's different than Dave's. Dave's is different than John's. Different than Rick's, right? So you just start where you're at. But obviously, if someone's making $5 million a year, the rules kind of change with really, really, really high income earners. You can kind of be a lot more flexible with the guidelines.
Yeah. Yep. Now, and then Stephen asked a follow-up question about, getting policies on the whole family. What's that look based on different incomes? It's still going to be the same percentage of income spread across all of the policies.
Right. Total premium.
Yeah, total premium that you pay on all of the policies that you're funding, that you're paying on.
Yeah, the 15% would still apply.
Yeah. So a lot of times when people go through underwriting, they say, let's get me and my spouse, both of us policies. You may want to wait until both of you are approved in order to decide on the final design, because maybe one of them doesn't get approved, then you could use all the premium on the other person. But you're going to take that max premium and split it between the two. Like that's the most you can do.
Yep. And we've had other clients do like a combination of whole life and convertible term, like the non-working spouse got convertible term over, a 20 or 30-year duration, and the bulk of the whole life premium is paid on the breadwinner. So there's different ways that we can spread the premium dollars around, and that's going to be specific to your case and how we do that.
Yeah, we kind of we poo-poo on that common phrase, buy term and invest the difference, because it's stupid. But that doesn't mean term insurance is stupid.
Right.
So we definitely use convertible term insurance, and that at a bare minimum, everybody should have that in place.
No question.
So that they can convert that to a whole life policy later on down the road. All right. You want to move on to Dan's?
Dan's got a good question. Sure.
My good friend has a whole life policy with a stock company. Could you please explain to him how he can convert his existing policy to an IBC policy? So that's, if somebody's got a whole life policy in place, I 99.9 times out of 100 would not do anything with that policy. I would say keep it going. Very rarely would I ever say, yeah, you should go ahead and stop funding that and transfer it to a different policy. I would just say, if he didn't do it with the intention of creating like a banking style policy for the purposes of infinite banking and financing his life, then it's probably a pretty low premium anyway. And he could just start a brand new policy with the right company and the right agent and the right premium.
Right.
So you don't have to kill that whole life policy, because a lot of times people have those for years. They're going to be good no matter what, if you've had them long enough.
Yep. Like perfect example is my children had regular vanilla whole life since they were 30 days old. They're $100,000 policy. They're very low premium. They're about $30 each per month. And that premium is fixed for until age 100. And I think the policies endow at that age, actually. So they'll just send my kids a check for $100,000 or whatever. So they're very cheap. There's no reason to replace them at all. I'm not missing the $30. So we just opened up additional policies when Dave introduced me to IBC. So just add to the system.
Yep. But Dan, just put your friends in touch with me. We'll have a conversation. Rhonda, can you ever exceed the amount of term insurance? I'm not quite sure what you mean by that.
Rephrase. You can
try.
Maybe the question is you can only convert up to the amount you have. So if you have a $500,000 term policy, you can only convert $500,000 worth of death benefit.
Okay, sorry, that was my question. I couldn't get myself off of mute. Yes, you
can
can never exceed the term.
Not without going back through underwriting.
Right. Correct.
And if you go back through underwriting, you have to go through another medical examination?
Possibly.
Generally.
Yeah.
Okay, thanks.
Yeah. But, I mean, they could find that you're uninsurable, but then, it's not like they can change the rating on your term policy. They still have to let you convert that 500,000. So it's kind of like no harm, no foul. You go through underwriting and they either say, hey, we can give you more or we can't. And then you're back to where you are right now at 500,000. If that makes sense. Steven, you listen to every single episode in Ryan's 9-hour YouTube series. So he's talking about Ryan Griggs' 9-hour YouTube series. That's a great series. If you guys want to dig that deep into whole life insurance, it's mostly about whole life insurance. The product as opposed to the process of infinite banking. So Stephen, if you still haven't moved forward with IBC after all that, I don't know if you have or not, then what are you waiting on? It sounds like it's time to take some action now. So reach out, man. Let's talk. All right. So Rebecca, yep, she got policies on the kids. Got a lot of clients coming back to get policies on the kids recently. I think people are really starting to see the benefit of that. And it's kind of the natural expansion of your system anyway. You start with you, then you start with the spouse, then you go to the kids, because that's a great way to transfer wealth to the kids, like with no tax implications down the road. I mean, you could stack those policies, 20, 30 years from now, you give them, make them the owner of that policy. They have access to all that cash value, and there's zero tax implications on their side. Now there's gift tax implications on your side.
Right.
But that's something you can address at that time, but it goes against your lifetime gift tax exemption.
Right.
So typically not a big deal.
Reread the part about cogeneration of power in Nelson's book. Even distribution of age classes. We're trying to create perpetual family wealth, right? And this is, frankly, an easy way to do it in a guaranteed manner.
Yep.
With control.
So we can probably cover Ben and Rhonda's questions together. So what's the difference between a policy like we're talking versus a vanilla run-of-the-mill whole life policy? You go to State Farm and you say, I want a whole life policy, and what they issue you. What 95% of the insurance industry is going to issue you is 100% base, which means you're getting the most death benefit for the most permanent death benefit for the least amount of premium possible. We do the opposite. We say, how much premium can I pay and get the least amount of death benefit? Sounds a little weird, but how you do that is you mix and match the base and the paid up additions. Those are the two big components. Paid up additions is just like buying permanent insurance, but you're buying a little bit of death benefit, and the majority of what you put in there from that paid up additions premium goes towards cash value. So it creates that cash value much quicker, which is why we add that as, typically half or possibly even more of your premium is made up of that paid up additions, which creates early cash value. So you can start financing the things of life very quickly, as opposed to having to wait 10, 15 years for that base premium to start creating a whole lot of cash value.
Yeah, your typical non-participating or non-dividend paying policy that you get from like USAA or through First Command or something will take 21 years probably to break even, meaning your cash value available vice the premium you've paid into the policy are now even. We can illustrate policies that do that in, year 10, year 9, year 8, year 11, year 12, depending. And even if they're all base, it's, probably year 14 to year 15. So still pretty good. But on to the break-even point, I don't care. Don't care.
Yeah.
When that happens. Year 6, year 5, year 8, year 10, I don't care.
Yeah.
Anyway. That's just me. All right. What else we got?
So Rick asks, would you prefer the LPUA over the FPUA? I know it's an opinion, but is the flexibility better for long term?
So the LPUA, Rick, is more flexible. So that's all I've ever used on, the 250 policies I've written is LPUA. You can pay. Now we're talking about, I'm going to just say it. This is a Lafayette product question from Rick, I believe. So the FPUA is a little bit longer duration. You can stretch that out past age 75 a little bit, but it's not flexible either. So I like the LPUA every time for that purpose.
Max flexibility.
Max flexibility. So And there's a way you can illustrate LPUA where it's underwritten but not they're not expecting it. It's the additional optional LPUA, which is some functionality they added last year. Anyway, I use LPUA, and I know Dave does too.
Okay, I've played around with it in the models, and I've seen the flexibility in it. I just wanted to get a second opinion from someone else that's a little more matured into the process than I am.
Yeah, LPUA every time.
All right, good.
Yep. Hey, I got a message from Pete, who actually Pete's an old fighter pilot, but I'm not going to say he's one of my eldest clients, but I'm going to say this is a guy who this is a guy who realized age isn't a factor really when it comes to this. And I'm happy, like, Pete, please give us your feedback. Why at your age, being so close to retirement, why did this make sense for you?
So I'm not afraid to say it. 63 is the new 40. Go for it. So here's the deal. I'm an airline pilot now. I have a pension coming my way, and I had to buy, about 4 years ago, I bought a term policy so that in the event of my death, my wife would be taken care of, and yet we could still retire with the full amount of my pension rather than annuitize it. Because my financial advisor, whom you have had on the show with you, Ryan Fleming, said, look, you could look at the numbers. You can lose $1,400 a month, or you can pay about $700 a month in premium to put a policy in place that will have you good to go. It's like, okay, that seems great. And that was a term policy for 20 years. And after 20 years, we'd be relatively self-insured if something happened to me. Well, or, after that, well, there would still be enough left over. So we were all happy with that. And then about a year and a half ago now, I guess, we started talking about what could we do. We're looking at RMDs, required minimum distributions from your 401k. I didn't start early enough in down the Roth path, and I was having all kinds of issues with that. And Ryan goes, you may want to look at this whole life thing. I'm like, dude, I got enough insurance. I really don't need it. Not interested. Plus I just bought $1 million term life policy. It's costing me $700 a month because I bought it at age 60. But I reached out to you, Dave. You said, read the book. I read the book and I went, oh, okay. I still think I'm too late. I'm going to be 63 this year. I think I'm too late. And read the book. And I know you talked about it on the podcast, that whole life actually turned out to be cheaper in the long run than the term life, which blew my mind. It still does to this day. And now I happen to be in the fortunate position that we were in the process of a move. I got a house. I didn't have enough extra cash laying around to lay out that kind of money on a policy, but we were going to buy a house that was fully paid for. And when I looked at the numbers of, do you pay for the house and have debt equity, or do you take a mortgage on it and invest that? That's what we did. And we're using that money now to pay the premiums on this. And it just has made so much sense. So I wanted to tell people that age shouldn't be a factor. It is actually still cheaper to buy whole life insurance over term life insurance. If I have the blessing of being relatively healthy, and of the 4 people in my family, a child who's 22 doing light civil flying, so she's not as insurable. My son has some health problems, so he wasn't as insurable, and my wife wasn't. So as the oldest guy in the family, I was still the most insurable person in the family, and it wound up being cheaper for me to do this and go down this road. And what was the other factor in it I wanted to mention is this allows me to keep the accelerator on my 401k and my IRA, because now I have in a down market a cash reserve to go to give me income. And so I just wanted to share that with folks. I was scared to death. I'm like, there's no way in hell I'm going to do a whole life insurance at age 62, 63. And boy, was I ever wrong. So I just wanted to share that with folks that, even when you achieve geezer status, it still can make financial sense. So.
Well, Wow, you
So
hit on a
thanks for
lot
letting
of
me
stuff.
speak and share that.
Yeah. Thanks, Pete. You hit on a lot of different points there. One of them, you talking about the expense of whole life versus the expense of term insurance. If you're doing $700 a month for 20 years, that's $168,000 that out of your pocket
gone.
you don't get back unless you die within that 20 years.
Right.
So, you know, at year 19,
Not interested in that option.
Your wife's like, all right, Pete, come on. Just,
Yeah.
you've had a good life. Let's go.
Yeah.
Right. But with the whole
I
life,
won't eat my mushrooms.
with the whole life, and we did a whole episode on this, how whole life is actually, quote, cheaper than term life because you're going to get back everything you put in. And even at the age of 63, the cash value accumulation, you can design the policy to match the same cash value accumulation as somebody who's 50 or 45 even. It's all about the flexibility of the design. And now you've got, like you said, that volatility buffer. When the market's down, you don't take out of your 401k because that's bad news. Sequence of returns risk. Why would you sell low? You don't have to because you got a bunch of capital right here you can access tax-free at any time and live off that until the market rebounds. So you hit a bunch of great points
story.
there, man.
Keep drinking that Jeremiah weed.
There you go.
They stopped making it.
They
Yeah,
did.
did they? That's too bad.
Yeah. So Pete's got a podcast called So There I Was. It's just a fighter pilot story podcast. So give that a listen if you like flying stories.
There you go.
All right. Let's see. Was there any? It looks like Daniel had one.
Daniel's got a question. Better to open up multiple smaller policies or start with one larger one and do the others once you reach that point. Kids are 9, 12, and I haven't started a policy of any kind yet. So my take on a fresh kind of family, problem set is we've got to take care of the breadwinner or breadwinners first and foremost, right? The bulk of the premium needs to be paid on the parents, regardless of the other parent is working or not. Both parents, if they're insurable, should have the bulk of the premium paid on them. And then if we have some children, we can use a little bit of premium dollars on them, and then we can add a special rider called the OPI, option to purchase additional insurance rider, for the child, so that later, as they enter adulthood, post-college age, 22 and above, they can start buying additional insurance in 3-year increments. Still with me? Something just...
Yeah, I'm with you.
Okay. It just
I gotcha.
flashed. It was weird. It's like... Anyway, so that's what... I hope that answered the question. That's what I would do. I would start with the breadwinners and I work my way down.
Dave, can I offer one other thing? And I don't even know if you know this about me or not. I was widowed 30 years ago, and you can never have too much insurance. I found myself with a check for $100,000 and a child, and man, that was nowhere near enough to cover the expenses I was now facing trying to find childcare and continue my career. So I'll add that in there too when you're considering the spouse or not. Well, there's no income to replace. Yeah, until you have to replace the work that non-income earning spouse is doing. So I'm sorry for butting in, but
no, that's
yeah.
You just highlighted a point we make all the time, and the question is, we always ask fresh clients this or prospective clients, if he or she were to die, how much death benefit would you like to inherit? And people, they think it's a number. Well, the answer is as much as they could possibly get.
Yeah.
There's no number. $1 million, it's not, it's not what it was in 1985.
Even 30 years ago, $1 million would have been probably barely adequate for my needs. Suddenly, if I had an infant son and an airline career, and it was you don't want to be forced to find childcare on the cheap. That's the last thing you want to do for your kids.
Yep, that's right. I think around here, people that have these nannies and stuff, I think they pay $10,000 a month or something. I mean, it's a lot.
Yeah. Yeah, that's a phenomenal point because I can't even imagine what it would cost to. That's why my wife, I've got 2 policies on her.
Yep.
Right now, so hopefully that would be enough, with the coverage I have on her to replace the actual work that gets done around the house. But it's a lot. I know that.
The safety and well-being of our soldiers, families, and civilians.
Was that a comment for us, John?
Oh, I'm sorry. Hi,
Oh.
Mike.
Hot mic. Could have been worse. I'll
Gets
mute
a
you.
pass because he's one of my best friends. So
Yeah, I know John. All right. Well, yeah, I'll go back to Daniel's question real quick. Because some people think there's a benefit to, hey, you have like 12 or 13 policies. There must be a benefit to having a lot of policies instead of just one. No. The reason you have more policies is because you need more room for the expansion of capital that you're accumulating in your life. Your income goes up. Time to get a new policy so you can put more of that capital away and sequence it through a policy. Because once a policy is in force, you can't increase the premium. You can't say, "Well, I'm making twice as much now. I want to add 50,000 to my policy." No, you can't do that. You got to open a new one. So
that's where
and
the
then
convertible
getting
term
everybody
comes
insured.
into play.
Yeah. So I'd say big takeaway is look into convertible term. Even if you're not ready to put the premium into a whole life policy to make sense right now for you, convertible term, so that you can set yourself up for success in the future as soon as you're ready. All right, everybody. Hope you enjoyed the replay of that live webinar. We got the next one coming up March 13th. So get in the show notes and register for that. Until next time, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.